Hey, welcome back to the podcast. Today we are diving into Ola Electric's recent financial performance. It's February 7th, 2025, and they just released their Q3 FY25 shareholder letter. Buckle up, because it's a bumpy ride.
Always is with these ambitious companies, right? So, to kick us off, Ola Electric, as we know, is all about electric vehicles, mainly focusing on two-wheelers. They've got a pretty strong presence in India, and they're pushing hard on technology and expanding their services. Anything big changed recently?
Well, they've been pretty busy. They just started delivering their Gen 3 vehicles, and they're also making a big move into the motorcycle segment with their Roadster series. Oh, and tons of new scooter models like the S1 Pro Plus and the Gig series to try and grab different slices of the market. I mean, it's impressive expansion.
Okay, product diversification is always interesting. So, let's get into the numbers. What are the key highlights from their income statement? Revenue, net income, that kind of thing.
All right, so their revenue for Q3 FY25 was 1,069 crore rupees, which is down from 1,240 crore rupees in the previous quarter. Deliveries also dropped to 84,029 units. Not exactly going up, right?
Yeah, a bit of a dip there. What about profitability? Were they at least making more money on each sale?
Not really. Their gross margin was 20.4%, and their consolidated EBITDA margin was a hefty negative 40.7%. So they're still burning cash, but the gross margin is slightly up year on year.
Ouch, negative 40.7% EBITDA margin. Sounds like they're still in heavy investment mode. Any one-off items messing with the numbers?
Absolutely. They had 110 crore rupees in one-off costs related to fixing service issues and warranty expenses, plus a 13 crore rupee charge for workforce rationalization. The usual growing pains.
Workforce rationalization, a fancy way of saying layoffs. Okay, so higher expenses and lower revenue. Not a great combo. Before we move on, remember, folks, disclaimer, we advise investors to check with certified experts before taking any investment decisions.
Good call. Now, what about the balance sheet? Any red flags there, or are they managing their assets and liabilities okay?
The auditor's report mentions that they reviewed the consolidated financial results, including 8 subsidiaries. Apparently, these subsidiaries had some losses, but the parent company's management says they aren't material to the overall group.
Okay, that's somewhat reassuring, I guess. But overall, it seems like they're burning a lot of cash and relying on that IPO money from last year to stay afloat, right?
That's the sense I'm getting. Now, how's the cash flow looking? Are they generating enough to cover their expenses and investments?
Well, no specific cash flow numbers are given in this shareholder letter, but given the negative EBITDA and ongoing investments, I'd say they're heavily reliant on external funding.
Right. So they're definitely in that high growth, high burn phase. Let's talk about the different business segments. Are they breaking down performance by scooters versus cell manufacturing?
Yeah, they've got two segments, automotive and cell. Automotive is obviously the bigger one with 1,045 crore rupees in revenue this quarter. The cell segment is still small, bringing in only 3 crore rupees.
Cell manufacturing being their battery production, right?
Exactly. They're hoping their in-house 4680 Bharat cell will significantly reduce battery costs and boost margins starting in Q1 FY26. That's when they expect to start using them in their vehicles.
Vertical integration, smart move if they can pull it off. So, are there any key financial ratios we should be paying attention to?
Well, profitability ratios are obviously a concern given the negative margins. They aren't paying any dividends, so we don't need to think about dividend payout ratios or yields.
Makes sense. They need to conserve cash. How do these numbers compare to their past performance? Are they improving, getting worse, or staying the same?
It's a mixed bag. Revenue and deliveries are down compared to previous quarters, but the automotive gross margin has slightly improved. They claim to be fixing the service issues that hurt them in Q3, and they expect a significant gross margin improvement moving forward.
All right, so they're talking the talk. What's their outlook for the future? Any guidance from management?
They're banking on their Gen 3 vehicles, the motorcycle segment entry, and increased vertical integration to drive growth and improve profitability. They're aiming for auto segment EBITDA break-even at around 50,000 monthly deliveries.
50,000 units a month to break even, huh? That's ambitious. Any potential risks on the horizon?
plenty. Increased competition, regulatory changes, and macroeconomic factors could all impact their future earnings. They also mentioned that they received a notice from the Central Consumer Protection Authority, though they don't believe it will have a material impact.
Yeah, those regulatory headwinds can be tricky. Okay, so what's the bottom line? Should investors be excited, cautious, or running for the hills?
Well, Ola Electric is still in a high risk, high reward phase. They're growing rapidly, but they're also burning a lot of cash. If they can execute their strategy and achieve profitability, the stock could be a winner. But there are no guarantees.
It's a bit of a gamble, right? High potential, but also high risk. I guess it comes down to an individual's risk tolerance and belief in the company's vision.
Precisely. So, as always, do your own research and maybe, consult with a financial advisor before making any decisions. Now, if you are enjoying the show, do like, share, and subscribe to our YouTube channel for more awesome content.
Absolutely. We want to keep bringing you the best insights. And remember, folks, this isn't investment advice, just our take on the numbers.
All right, that's all the time we have for today. Thanks for tuning in, and we'll catch you next time.
See ya.